So as we look at the first quarter of 2019, as we said, it's somewhat of a microcosm of that 2009 through 2019 stretch. As we entered into the fourth quarter of 2018, we saw the market really doing quite well, a lot of optimism, and then suddenly the market started to fall in October. It fell somewhat dramatically. In fact, as we stated, the third worst fourth quarter in the market's history. We dropped down a total of, get this, 19.8%. Now, an official bear market is 20%. The S&P went down 19.8%. So we didn't officially have a bear market, but we're saying we had a bear market. If we look at every other asset class, we did see those bear markets. The NASDAQ, small cap stocks, some international areas, international stocks, China. We saw dramatic pullbacks in the market, far in excess of that required 20% to state a bear market. Just the S&P survived, and that was held up by just a handful of stocks. So as we can see on the chart here, I love the headline in the New York Post, "The Stockings Suffer." That talks to us about that worst December in the market's history. Remember, what traditionally happens in the fourth quarter, it's traditionally a volatile quarter. September, October, you tend to see a lot of volatility. That tends to be where the market goes down. November is somewhat of a malaise, and you may see another bottom. In December, the Santa Claus rally tends to be quite strong. December traditionally is a very good month in the market, and what was different this time was December was actually quite poor. But this rally is, again, extraordinary. So we look at the first quarter, the market rallies back up 24%. And depending on what asset class, what we saw was if you went down further, you came back further. Now, what caused this? Well, it is our belief that this was a Fed-generated move. There's a lot of talk about political issues. There's talk about the China trade and those negotiations. There's talk about oil prices and fear of recession. When we look at what caused the pullback in the fourth quarter, Jerome Powell came out and had his first public talk, talked about being very aggressive with interest rates, and the market went straight down. Jerome Powell came out at the end of the year in January and said they were going to be far more dovish and more careful, and the market rallied. This is, without question, higher interest rates will always panic the market, especially when it's unexpected. So we now know that A, the economy is recovering. Data continues to pour in and show re-acceleration in the economy. We heard a lot of recession talk in the fourth quarter. Now we're hearing re-acceleration in the first and early in the second quarter, and the market is rallying accordingly and heading back for new highs. So let's put the slowdown, this fear of a slowdown, in perspective. These are some of the leading indicators in the economy, and as we'll see, green arrows mean we're above average, red arrows, warning sign, and then we have one that's neutral. But as you can see, as you look across, whether it's manufacturing or services, consumer strength, confidence levels, home sales, small business optimism, these are all pointing green. We only have a couple in the red arrows. And again, those are still not in a recession area. They're still above that level, but lower than where they have been. So the arrows tell us that the economy is still strong and continuing to look strong in terms of leading indicators. And so we're going to still keep the green arrow on the economy as a whole. On the next page, we'll see Eurozone expectations. So one of the challenges in the marketplace today is Europe. It has been slower. They have been struggling. The Brexit is occurring. And across Europe, there is fears that if they go into a recession, could that drag other areas like the U.S. down? Well, the good news is in this next chart, we'll see that we're actually starting to see Eurozone growth expectations picking back up again. So why is that the case? Well, when currencies adjust, in this case, for example, the sterling goes down, that makes their products cheaper. They become more competitive. As Brexit starts to come to a close, and it's not there yet, we have a long way to go, people start to look forward and look ahead if there's a deal that relieves one of the concerns. What we're also starting to see over in Europe is a much more accommodative central bank. Mario Draghi, when he started to see the slowdown, he is the chief of the central bank. He came out and said they were going to have a much more accommodative monetary policy. And so, once again, the central bank's coming to the rescue, and we're starting to see just the early signs of Europe showing some hopeful signals. As we look at China, China was the other area in the fourth quarter. There was great concern. We saw the same thing in 2015. People looked at China, said they're slowing down. They're slowing down too fast. If China falls, the whole emerging market goes down. That's obviously a concern. And so as we look at this next chart and we look at new loans from the banks in China, you'll see in last year in the fourth quarter, those were declining somewhat rapidly. And then suddenly in 2019, they jumped tremendously. Why is that? Well, because the required deposit ratio, which is set by the Chinese government, as you'll see with the red line, has come down dramatically. In other words, China knows they're slowing down. China's stock market has fallen dramatically. Consumer confidence has started to pull back dramatically, and China's not ready for their party to end. And so they are starting to stimulate their economy, and we've already seen an uptick in growth. China's number somewhere around the 6.4 growth range, which is actually quite strong. We talked about the Fed already, but this next chart shows you that the Fed, where we had these extraordinarily accommodative monetary policy decisions, we'll see in the fourth quarter, the Fed started to talk about that rates were going to go up significantly. They were going to be aggressive. And what we really focus on is the real Fed rate, which is take the Fed rate and take out inflation. When that's at zero, then we are at a very easy monetary policy. And when it's below zero, which we were back 10 years ago, then it's highly accommodative. When we start to get over zero, then we are starting to add a little bit of concern. Now, recessions happen at much higher numbers. Today we were at 0.6, barely above zero, so still not an aggressive Fed. And as you'll see, the average real Fed fund rate in a recession is 2.67. So a long way to go, and the Fed is starting to signal that they are not going to be aggressive, despite what they said earlier last year. And finally, one of the other measures that gives us confidence that rates are not going to suddenly run away from us is what's happening around the world. The United States actually has higher rates of return on their treasuries than most other countries, especially in Europe. That's illogical when you think about it. If we're the largest economy, the fastest growing economy, and one of the safest economies in the world, and the safest lender, well, then why would we have to pay more interest rates than a country that's not quite as strong as ours? Again, that doesn't make a whole lot of sense. So there's a limit as to how far our interest rates can go. This next chart shows the impact of all of this stimulus in the marketplace. And what it shows is the aggregate negative yielding debt. So this is the total amount of debt that actually has negative yields. Now, as you'll look back at 2010, this was unheard of. There's no such thing as negative debt. Take a step back and think about that. You're paying the government to hold your money. This happens in Germany. This happens in some of the other European countries. So you see a little blip up in 2011, 2012, because that's when we had the European financial crisis. It goes away. And in 2015, 2016, negative yielding debt volumes exploded. It pulled back when the market got better. And as you'll see, this quarter, those numbers are starting to creep up again. More negative yielding debt is coming back into the market in Europe, and that's that monetary stimulus. So if we have this large swath of negative yielding debt, it's hard for the U.S. debt to run away to higher and higher numbers. And again, the stock market doesn't like interest rates running much higher.